Welcome to Money Hangout, our weekly interaction with you where we try and share our understanding, some insight on saving and investment issues. This is brought to you by Birla Sun Life and Value Research. Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about uh, the favorite asset class, the favorite investments, or favorite things, which I would not say investment necessarily, but Indians are fond of the gold and real estate. Things have changed very different. Things have changed of late, and things can change dramatically in times to come. And it is important that you should approach real estate and gold differently than the way you have in the past. Simply because you must have the context, you must have the understanding. You should have a home. You should have a little bit of gold. How you should look at it? Should you consider them as an investment? Should you ever make an investment in real estate and gold to profit from it? If so, why? And if not, why not? I'll just share some statistics, my understanding of these two asset classes and how you should approach them. First, about real estate. One is that everybody should have one. You should have a home of your own. It provides you great emotional comfort. Uh, Worst of times, you will have a shelter. So that is a good enough reason to have a home. Then some of the economic reasons. You save on rent. You don't have to worry about your landlord driving you out of that house. You get continuity. And potentially some appreciation as well. So saving on rentals, rental outflow, and potential appreciation is a good enough reason for you to have it. And that is exactly how you should approach real estate. If you plan to live in that house, and if it is likely to appreciate, and you will be enjoying it at the same time, then by all means, muster you stretch a little bit to get that home, but nothing beyond that. Don't think of buying that second home. Don't think of buying that you know illusory home, which you may not get. Don't think in terms of trying to make big bucks by betting on a home for which you have just paid 5%, and you are expecting to profit from appreciation, so your leverage trade will work. That is not the way to approach a home purchase. There are two, three other things which you should have in mind. First, I would like to clarify that I would just like to share some understanding, my own perspective in terms of why people have this great idea, why people have this impression that real estate generally always does well, and the charm of real estate. One is that real estate is real. You can feel it, you can experience it. Not that other assets that you invest in are unreal, but you can't experience them as much. So these, gold as well as real estate, you can enjoy them, you can experience them, and you see it physically sitting there. Even though if you have made an investment, its value goes down by 25% if you plan to sell today, but you still feel happy that uh, you can experience that home. So that is one aspect. The other is that people have misimpression that normally the real estate holding periods are very long, 20, 25, 30 years, and then the power of compounding coupled with appreciation, it actually gives a very magical number. Somebody bought a house for a land for 50,000 rupees, and today it is worth 1 crore rupees. Is not a very unheard of experience example. But the point is that if that is the time period for which you would have bought any other asset class, any other growth asset, yeah, that would have also appreciated. 30 years back, if you would have bought Sensex at 100 rupees, that will also be worth 30,000 rupees today, with a lot of ups and downs and with a lot of dividend yield, poured in. So I would say that a long period of time exaggerates, and typically that of course is an advantage, that you don't think of real estate as something which has to be bought and sold every now and then. You end up holding it for a long period of time. That creates a very different impression. But if you are a disciplined investor, you will have far other advantages. One is the ability, simplicity, diversification, small ticket investment. You can't buy a real estate with 5,000 rupees or 2,500 rupees a month. Then comes, your ability, low maintenance. You don't have to worry about looking for a tenant or maintaining that house, and even on a 30-year, 25-year, 30-year basis, the house goes out of style. The kind of construction, it remains relevant. Relevant or not, then it has to go into a reconstruction and all those things. So it's a simplicity of it. So that is why I think that one should not consider it as an investment. You should only think in terms of buying a home. Two, three rules which you should follow when buying a home is that you should not be overstretching. You should be prudent in your approach to buying a home, which is, you should have 20 to 25% of your down payment with you. Don't leverage yourself beyond a point. You should not be spending more than a third of your monthly income in repaying that loan, whatever you borrow. Third is that, which I think of late has become very important. Buy a house after a due diligence, so that you definitely get that house in a defined time frame, and that defined time frame is 6 months to 1 year. If you are unlikely to get in 6 months to 1 year, then I don't know how long that delay is, and all your plans will go haywire. You have to be very careful, more so in the north. The Delhi and NCR region is where I live in. I see all kind of horror stories around, where people have paid, waited, and they keep on waiting, and they don't have a recourse, and the legal framework is taking its whole time. We have the real estate regulations, but the real estate regulator is nowhere to be seen. Uh, some of these builders, developers, most of them are unable to honor their commitment, and they're only deferring it. So it's a very difficult situation, and that is the case with 80-85% of the houses delayed indefinitely, and when do you get it, you don't know. So be very careful about that. You just might, for the charm of your house, you just might be losing a lot of your money without a resolution in sight. So that is, and then of course, as I said earlier, that you should plan to live in that house and save on that rent. If you have these four variables in place, you will have a nice stay, and it will be financially extremely rewarding. Then comes gold. This is another thing which has gone into a very speculative fervor 5, 7 years back. A lot of things happened. Gold is not a productive asset. Think of the three things which an individual acquires. You either keep a deposit, or buy a bond, or buy a bond fund, or the money lies in your employee provident fund, so it is yielding fixed income. So you effectively, these are methods in which you lend your money to somebody. Then you buy ownership. Whether you buy shares or you buy equity funds, you are effectively doing that in some fashion. And then you buy a house. So house is also an asset which, in the worst case scenario, will give you a rental yield. And if the economic activity around the house, where you have your house, grows, then that house goes up in value. Yeah, and if it's a great location, it commands a great premium. So if these three asset classes, there is economic logic why they go up or down. Uh, and there are reasons why they go up. If the variables are reverse of that, then it will go down. If the economic activity goes down, the house value will go down. If the potential outlook for that company turns bleak, as so the stock prices will go down. If your company, to whom you have lent your money, the general interest rates goes down, there is more supply of money, or that company turns out to be a poor credit, its value will go down. So they go up and go down for economic logic. In case of gold, there is no such thing. What happens with gold is, the price goes up over a period of time, because there's a history to it. Undoubtedly, it has a longer history than the organized financial history we have for stocks, bonds, and markets. The organized financial system that exists today. So, from the times of kings and kingdoms, we have gold has been relevant and a store of value, and there is a finite supply. But the whole value today, the outlook for gold is that more people will want to have gold in future. There is a finite supply, so the price will go up. But there is no economic logic. The damn thing doesn't produce anything. Uh, and of course, there is a possibility that the demand will go up steadily over time, and not in a speculative way. That itself is a reasonable reason enough. But beyond that, what happened to gold in last 5, 7 years is quite extraordinary. One is that the global financial crisis happened in 2008. Equity and bonds tanked first time together, and in a quite a unprecedented way. So that was a massive blow. investors ran for cover. They ran to buy gold. Gold was easy to actually access because 2, 3 years before that, the financialization of gold happened. So you could buy gold futures, could buy gold derivatives, you could buy gold ETF, and that created a phenomenal rise in demand for gold. Besides that, the emergence of India and China for cultural reasons, where it remains a ceremonial thing, and a rising affluence created a whole new demand in India and China. So these two things coincided in a manner which I think is once in a century kind of situation. It can happen again. But that led to the surge in gold prices. And today, because of that, the gold prices, the long-term returns look so impressive. But over a long period of time, gold does not beat inflation, and understandably so. It is a store of value, and it should be looked upon that way. It should be looked upon as a high-value emergency fund. Nothing beyond that. Or you should look at it as a consumption. You should buy jewelry, you should enjoy it, you should show off, and you should consume it. Nothing beyond that. Not as a store of value or as an investment which you can say, because it's not a great investment when you buy it in the form of a jewelry. Your ability to sell it back at reasonable price, the transaction costs are very high. Financial forms of holding gold is also becoming little expensive. Of course, one is that the underlying asset is not very promising as a long-term investment. Then comes, should you buy it in the financial form? Not really, because there are 2, 3 ways in which you can buy it. One is the gold ETF or the gold funds, which in turn buy gold ETF. They cost you 1.25% annually to hold them, and of course you'll be able to track the gold prices exactly as uh, less this expensive. Of late, there is one more alternative that has come your way, which is the sovereign gold bonds. Government of India issues that they don't want you to buy gold, so they have provided this avenue which earns you gold prices plus 4% annually, which I think is a great thing. Just in case you are unable to dissuade yourself from buying gold, that looks like the finest way of holding gold, or locking yourself into the gold prices with an additional yield without the expenses of gold ETF or a gold fund. So I would say that look at these things objectively. I've explained you the rationale why you should not. You should have a home, you should have the jewelry, you should have a little bit of gold, nothing beyond that. Don't look at them as a great investment. I don't think it will be a very productive asset, and that is the basic premise why I discourage you. Happy investing. This will actually free a lot of your money to be invested more productively.
Thank you, Dhiren.
Thank you.
We have a number of questions on these traditional favorites. To begin with, Mr. Mehta says that despite low rental yields on real estate, the dividend yield on Nifty stocks is also low. So, why is equity considered a superior investment?
Uh, One is that you have lower risk relative to this. Of course, there is a risk in terms of if you get carried by the noise. I don't think equity is considered lower risk. I think the point I'm making is that potentially equity should produce more returns. And right now at this stage, after the 4 or 5 years of speculative rise of real estate and complete aberration in the marketplace, real estate marketplace is very distorted. Uh, Everybody knows that a great amount of cash can be deployed in real estate. We have a very skewed kind of demand. There are a lot of speculative buyers who are unlikely. The underlying demand for the real estate is missing. The quality of real estate supply and their ability to deliver it on time is suspect. So I would say that today real estate investment has become very difficult. Not only that, this 2-3% dividend yield potential rise, and with rising earnings, because what is the dividend yield? The other is that the underlying company, you can also compute the earnings yield. You see how much is this company earning, and dividend yield is one of the factors only for some set of companies. In fact, high dividend yield translates into some kind of catch in the company. If a company is yielding 5-6%, I would be very suspicious of that company. But in case of houses, if I don't get 4-5%, I would not find it attractive, because that is my long-term holding, and that is something which I would expect to earn from such an investment. So I don't think that is strictly comparable, because in case of companies you have a clear visibility of earning. So I would say that the case for equity is very different. You get diversification, low maintenance. You can get out of it on demand at will, and there is a complete realizability, very low taxation rate, absolutely no maintenance. So these are the points which actually makes it more attractive.
Sure, Dhiren. Next up, we come to the big event in the real estate market in particular, demonetization. Hemant asks about the impact of demonetization on the price of undeveloped real estate, which is located on the outskirts of cities and in tier 2 cities.
Real estate, the outlook varies on very specific things: the specific location, the specific city, the potential economic activity that could emerge there, that can potentially happen there in foreseeable future. Those are variables which actually drive the return or demand for such real estate. So I don't know which specific city he's referring to, but he should keep in mind that if in 2-3 years time there is a possibility of great activity, economic activity happening there, demonetization or need or no demonetization, I think that we should not forget that demonetization will have an impact. There was always a scale of excuse me, amount of cash which was finding its way into real estate, and that will become difficult in times to come. But more importantly, if there is economic activity, people will be willing to write a check. If investors or buyers are going to get a reasonable return on their investment, and they have to, then there'll be a demand for that real estate, and it will go up in value. So I think you should look at things very objectively, define your expectations, and as I said, that real estate, if you are considering as buying a home, then what I discussed at the outset, have those 5-6 points in mind, and then go ahead and buy it.
Next up, Paul asks if it is better to invest in silver or platinum instead of gold, and whether they are good investments if there is significant inflation risk in India.
Uh, Possibly, but I have no idea. I've spent so much time in the initial session that why you should not have that gold or that, so, and I don't have much idea about the other precious metals. Uh, but you know, uh, if you're trying to prevent yourself from inflation, the only way to participate in is equity, because you get hooked into the inflation. You buy stocks of companies whose profits will depend on making money from the real economy. So, and a good company is the one which is able to increase its prices with rising input prices. And so the real charm of a stock is that it is designed and configured to beat inflation over time, because over and above this, it has to be competitive. There is a premium for the way the company is managed. So a well-managed company should be effectively able to beat inflation over a sustained period of time. Of course, it'll come with all kind of riders that the product and the services of the company should not become obsolete. It should still be relevant. It should be well managed, and it is managed by a set of people who will not steal money. So of course, that's a different realm altogether. But the primary case for equity is that producing real product and services which get aligned with the real economy and the inflation.
Next up, Parminder says that each asset class has its own cycle. So, how does one identify the real estate cycle?
Don't worry about these cycles, uh, because it's hard to guess which cycles, because the factors which drive these cycles, one, that these cycles are very long. Commodity cycle is very long, and for understandable reason. Economic cycles are long because it has its own, it has a life of its own. You will see a huge demand which will lead to great demand in a product or services, and prices will go up. Then more people will go about producing, creating a supply, and then the prices crash. So this is the natural way economic cycles work. But you don't know how long these time cycles are, because creating a steel plant has its own time scale, while producing more onion next season might just take take 6 months. So it depends on the product, services, economy, the state of the economy, other variables. There are too many interrelated things, so hard to guess that. But I think it's very predictable. You know your situation very well. Few things to do: put your long-term money into equity. Don't worry about the real estate cycle, and because there is a possibility. I have seen a phase, where people waited for 20 years to break even with their real estate investment, and that was in Gurgaon. That was near, of course, that place is booming now. But somebody who bought it in late 90s, it took him 10, 12 years to break even. So look at the opportunity cost, and that could be very tiring. And after 10, 12 years, if it's a finished property, then it also goes out of fashion. It becomes, the construction style, everything has changed, the design, the surrounding. So I would say that look at it very differently. I think if you are a little selfish in approaching things from your point of view, that will be helpful.
Sure, Dhiren. Our next question is about an emerging financial instrument concerning real estate. Ashi asks if one can invest in a real estate investment trust through one's demat account.
Uh, Today, it is not possible to buy it in real estate, invest in real estate investment trust. But tomorrow, it is a matter of time. SEBI has now prepared the ground for launch of real estate investment trust. The regulations are ready. Some players are also ready to launch their real estate investment trust, and it will be possible to buy. Of course, it will be a little different from mutual funds, investing in mutual funds. uh, Demat account or no demat account is not that relevant. The ticket size is going to be different. It's likely to be substantially higher. I think it is going to be 25 lakh rupees. Then the amount, the nature of real estate as we understand it, and the kind of real estate that you will indirectly acquire through real estate investment trust will be different. A real estate investment trust will primarily be some primary commercial real estate development projects, besides some rental yielding real estate investment assets. So, and my understanding is that a lot of existing real estate players who own those assets will be able to put those assets into real estate investment trust, and real estate investment trust will, so effectively, real estate investment trust will have a hybrid character. You will exactly have an understanding that when you buy this bond, when you buy this real estate investment trust, it has a 5% rental yield, or it is a 6% rental yield, or it has this much of expenses, or a post-expense rental yield of this much. Besides that, depending on the location and other things, you can guess yourself what is going to be the likely appreciation, because the configuration of commercial real estate rental is that you get into a contract to let out your commercial real estate, and you get those contracts get revised by about 10 to 15% every 3 years. That I think brings in a degree of appreciation as well in the yield. Besides that, just in you might get lucky. There could also be a provision of annual valuation of the real estate. It was bought at some price, or it was built at a certain price, and today, if it is to be sold based on this rental yield, it could fetch much more. So you will have a reasonable sense. And the way real estate investment trust will work is you will be able to buy these units in the primary market, at the primary issuance, and after that they will be traded in the market, they will be listed in the market, so the demat account will be necessary anyway.
Thanks, Dhiren. Next up, we move to another topic that has also been in the news. Dr. Mazumdar asks if you could explain your view about the long-term capital gains tax on equities and the need to act.
uh, the prime minister about 3 4 weeks back pointed or hinted that the participants in the equity market or participants in the market will should be paying more taxes. And what the market actually took a hint was that, we all understand that the capital gains the only asset which is exempt from any tax is equity if you hold it for 1 year. The STT, the securities transaction tax, is very low, virtually tending to be nothing. So everybody took a hint that maybe at the coming budget the capital gains tax might be introduced. Then the finance minister clarified that that is not the intention, and he said it in a reasonably vague way. But that looks unlikely, or or that was not on his mind. Uh, but still, this clearly looks that what actually it creates is, uh, if there is some possibility, then why take a chance? A lot of investors have bought into equity or bond, yeah, equity or equity funds over a period of time. They are sitting on huge capital gains. There are three possibilities. One is that nothing happens, so you don't have to do anything. But there is a possibility that there could be a capital gains clamped on, or what will happen is that you have to hold equity. The period can go up from 1 year to 3 years. That is also logical and understandable. That I don't think one can say that 1 year holding period is reasonably long term. It is not long term. So you should have a long term view anyway when buying into stock, buying equity. Uh, but assuming that there is, and the third possibility is that equity becomes taxable with indexation, which means all your past capital gains will also become taxable. Why take a chance? You are at no disadvantage as, by realizing all your gains and investing your money again. If you are able to do that, you will be completely able to de-risk yourself. It is legitimate. It is not tax avoidance. It is tax planning. You are preempting yourself. The worst case scenario is that you will be, if you are a long-term investor, you will keep holding your equity from here on, and it will become tax-free again for after a holding of 12 months, if nothing changes. So that was the whole idea why what I was saying, that investors who are sitting on big gains accumulated over a period of time, they should realize it to de-risk themselves.
Next up, Mr. Badial says that gold is required in Indian marriages. He asks what form of gold should he invest in for this purpose, the physical form, gold bonds, or ETFs. He has a 5-year time horizon.
Uh, 8 year time horizon and more, I think the choice is very clear. You should buy the gold, sovereign gold bonds, because you will have the money. It will appreciate by 4% more. And otherwise, I feel that the outlook for equity and fixed income remains reasonably attractive. And I think in the next 5 years, I visualize that equity and or even a balanced fund for your regular investment will be able to produce more return than gold. So why don't you do your SIP in gold, in a balanced fund, and after 5 years sell that investment and buy the gold?
On a lighter note, and we have time for just one more question, Haribabu says that despite reading and assimilating your articles, he cannot convince his wife to not buy gold. He says that she does so even though she has a lot of ornaments. So, how can he change his wife's opinion?
Don't change it. Incur the cost. That the rewards that you get are non-financial.
Thank you, Ziren. Any parting thoughts?
Um, Take this lesson. Real estate and gold, you have it in a limited way. Don't don't think in terms of, don't look at it as a active asset class. And a lot of investors, for some historic reason, uh, for all kind of examples that we see around us, are still not convinced. But I think it is better that you reconcile yourself to the modern economic world that will exist in. Think of equity, debt, and real estate only as your home, as a real estate. Don't get uh, attracted and lured to the gold and real estate. It will be financially less rewarding, and you will only have past examples which will mislead you. So take this to your heart. Be very objective in your investment decisions. That will come in handy.
Thank you. Thank you all for joining in. The 2017 Union Budget will be presented next week, and in next week's Hangout, we will tell you what it actually means for you. Join us.